So now let us try and understand one among the components of the financial system, which is a rich component, which we talk about as the financial market. The financial market essentially is divided into the money market and the capital market. And traditionally, we talk about money market being the market for short-term funds and capital market being the market for long-term funds. Now, let us take a very simple example as we started off in the last case. Suppose I take a wayside trader who is preparing tea and snacks for somebody on the roadside. Now, in order to start his enterprise, he might require a small vehicle in which he sells. Imagine he is a petty seller on the street who sells tea and snacks in a vehicle, in a moving vehicle. So he decides how to set up his enterprise. He needs a vehicle on which he is going to sell by the roadside. He needs some utensils. He might need a gas stove and he might need some vessels for his cooking. Now he decides how much should he spend on this moving vehicle in which he is going to sell, how much is the cost of the gas stove and the vessels which he needs to buy for his cooking. Suppose he estimates that his vehicle will cost maybe 15,000 rupees, the gas stove and vessels together another 10,000 rupees, then his project finance is 15 plus 10, 25,000 rupees. He can set up his enterprise with 25,000 rupees because he does not require land, machinery and so on and so forth. In a very micro level, petty enterprise that happens on the roadside, an ordinary entrepreneur thinks of 25,000 rupees in terms of buying permanent assets with which he can set up his enterprise. This is his project finance, this is his long-term funds that he requires. Now, once he sets this up, after purchasing the vehicle, setting up the gas stove and all his vessels together, now he has to start his operations. Here what he needs to buy some fuel, he needs to buy some milk, some tea powder, some flour and some other kind of things for making his daily snacks and tea. Now the amount that he requires to procure all this daily use operational items is his short-term funds, which is specifically called his working capital requirement. So what has this 25,000 that he requires for procuring his vehicle, the stove and the vessel is called the long-term funds, which comes under the capital budgeting decision. And the day-to-day operations, the next day is going to finance by the sale from what he gets in the first day. That is called his working capital requirement. Now here the market correlates to the same elements. The market has a direct correlation to the same elements. Let it be a multinational corporation for that matter. When they conceive a project, they require land, they require machinery, they require furniture, they require building, they require many other permanent inputs, and the funds required for that is their project finance. And once they set this all up, they require funds for their day-to-day working, that is their working capital requirement. Now in the market, matching the requirements of their long-term project finance, you have the capital market. Matching their requirements for the short-term funds, you have the money market in operations. So money market is a market for short-term funds. Players are typically banks. Capital market is a market for long-term funds. Players are typically the stock exchanges that you have. Now in your capital market, again you have a primary market, which is a market for new issues. You come up with new issues through an initial public offer using the book bidding process, and you raise money where the intervention of a stockbroker is not always essential. So you have your own ways in which you enter the market for the first time with a new issue. There you are in the primary market. Once the issue closes in the primary market, it is left available for free trading in the secondary market where you have the stock exchanges. So in this segment, in the capital market segment, you can have a primary market for debt, You can have a secondary market for debt. You can have a primary market for equity and a secondary market for equity. You can also have a primary or a secondary market for the derivatives. So here this is the financial market that you have. So here the financial market, which talks about money market, capital market, primary market, secondary market. The issue is how thick or how thin is this demarcation. Suppose you take a financial institution today as we did traditionally. Can you say that it is exclusively in the money market? Or can you directly identify it to be exclusively in the capital market is an issue over which we need to ponder. Say for instance, suppose I take the biggest public sector bank, SBI. It is a bank. In that sense, you put it in the money market. But then through the same bank, if I can have a demat account, if the same bank has its own subsidiary as a mutual fund, if the same bank is doing insurance business, how do I say that it is just a bank? Or can I put it as an institution which is there through which I even trade in the capital market, or through which I open a demat account, or through which I do financial services? So we cannot put the demarcating factor, or we cannot put the segmenting factor to be so thick as it earlier was. So what we need to understand here is the segments in the financial market or the compartmentalization which existed in the financial market earlier is not that thick today. The demarcation is turning out to be thin, and you cannot attribute an institution to be exclusively dealing in one particular line of activity, in one particular type of funds alone, and they have their own movements taking place. This is essentially a paradigm shift which has happened when you look at a market which gets integrated in that form. Now let us try and understand the features of this financial market that you have today. The fundamental feature which we just touched upon earlier is the fact that we have moved from a segmented market to an integrated market. Now what is the test for integration? The test for integration primarily comes in terms of pricing, the uniformity that you have in pricing, in terms of the transparency that you have in operations, in terms of the symmetry that you have in the information. Let us compare financial market with that of any other market for that matter. If you say a commodity market, in one particular city itself, say for instance in Bangalore or in Madras, Chennai that you go, a commodity will have different prices in different places because it is physically traded. And when you physically trade, there are people who do not know the varying price in different places. There are factors like convenience which influence price. The place where it is very easily accessible has a higher price. There are places where maybe the wholesale market has one price, retail market has another price. There are barriers which come through transportation. The place where it can be easily transported has a lower price, other place has a higher price. There are barriers in awareness. Some customers know about the price difference, some customers do not know. But when you have an integrated market, what happens is prices tend to be uniform because everywhere the price is something which is visible to all. So we are now moving into an integrated market where there is uniformity, not just uniformity, also the segments are getting integrated. Now we cannot say that one institution is dealing with only one line of activity and through that institution perhaps we cannot get other services. As I said earlier, when I go to a bank, perhaps I do my insurance business there, I do my mutual fund business there, I do my demat services there, I take all my financial services, I expect all my financial services to happen through the same one entity. So that segmenting, saying that only this is done here and that I have to go there, or this price that prevails here, that price prevails somewhere in a different form, that is not a reality today. That is where you have a market which is segmented, a market which is integrated. Second important thing is a second important feature of the financial market is cross-marketing. Today, we earlier talked about a phenomenon called bank assurance. Banks will sell insurance products, insurance company will sell banking products. You will have some NBFC services seen within the banking institutions, money transfer and so on. You will see a primary market kind of operation happening through some financial institutions which are not directly in the primary market, like I can subscribe to for an IPO. So you have all kinds of cross marketing taking place. So we are trying to leverage out of the strength of one and the strength of another. We are trying to make it a collated, blended, consolidated form in which you can get some services over there. Another major change of this age, or a major feature of the financial market today is that it is technologically driven. So you do all your trading online. You do your trading online. And if you look at the change that has happened in the business world today, it is essentially because we could make or we could bring up a system of electronic finance. We could build up a system of making movement of funds online possible. If you look at e-commerce, if you look at all models of e-commerce, it has happened because of this IT-enabled service which was supporting the financial market. So the technology change that you have, you have a straight-through processing model, or you have a technology-driven model where all your services can be done online. You buy, you pay from your bank, you sell through your demat account, the balance goes to your account, the surplus goes to your bank account. It all gets technologically integrated over there. Another important aspect is that the market today is externally and professionally regulated, because earlier we were looking only at statutes which regulate. Banks were regulated by the Banking Regulation Act, or insurance by the Insurance Act. Today we are going into an era of externally driven regulations which are professionally managed. As far as the capital market is concerned, they have SEBI. As far as the banks are concerned, they have RBI. You have all regulatory bodies in place where they will professionally manage your system by looking at standards which are to be the best as far as the financial system is concerned. Now, you also have globally driven standards, because once you have a globalized world, once you say that you are ensuring free movement of goods and services, then your standards also need to be global. Earlier, we were talking about big merchants and big multinational corporations who have regulated activities, standardized activities, their access increases. If I am complying with all standards of export and import, if I have my accounting standards as per international financial reporting standards, what we technically call as IFRS, if I meet global standards in my taxation, if I meet global standards in my accounting, if I meet global standards in my exports, if I meet global standards in my service conditions, then I am entitled to all kinds of instruments and services which are globally available. Funding from external agencies through external commercial borrowings, they take care of certain factors like how is your accounting standards, how do you meet your standards in terms of global trade. So if you are today in an era where if you want to have the best access of resources, if you want to take advantage of the opportunities that exist to the best of your advantage, your market has to be based on globally driven standards which you are looking for. And finally, the market feature that you look for here is innovative products. Market has got all kinds of innovative products. It is not just debt and equity which you see in isolation. You have a host of derivatives. What is derivatives? Derivatives simply means a product which derives its value from an underlying asset. So if I am not directly competent or directly willing to trade in the underlying asset, I still have an opportunity to trade in the derivative, where I can manage my risk, where I can hedge my risk, where I can take advantage of market differentials. So you have a host of products, exchange traded funds, you have funds of funds, you have all kinds of bonds in the debt market, you have all kinds of derivative segments that you have futures, you have options, you have the call option, you have the put option. So you have a derivative segment, you have a fundamental segment, you have a bond segment, you have an institutional segment, and all of them come up with, or all of them do come up with, a host of products which you have. So essentially the characteristics or the fundamental features of a financial market is it has become integrated, it has become professional, it has become well regulated, it is driven by very effective standards, and the technology has supported it in a big way. Now here again, when we go through this course, you will see how this platform, how this financial market helps in taking advantage of business models which are making you better placed in tapping opportunities which exist maybe in some nook and corner of the world. So if you are having a ripe idea, a good idea, the market has got all kinds of products from where you can source funds. The market has got all kinds of opportunities where you have deployment ways and mechanisms, and those are the features of the financial market today. Now, how do you look at the features, or how do you look at the fundamental aspects of a developed market? The key aspect is integration among the sub-markets, and that is happening in a good way today. If you see that the debt market is not very robust in terms of observing funds, there is always a chance that funds move from debt to equity. If you see that the equity segment in its originating form, in its primary form, is not very developed, you see that there is some movement into the derivative segment. If you see that the insurance is not giving the required kind of return, you see that part of your insurance funds moves into the mutual fund segment, or mutual funds and insurance funds in the form of domestic institutions going into the capital market. So we have adequate space, we have adequate room for taking advantage of the sub-markets, movement of funds between the sub-markets, among the sub-markets, because that integration is there. Now this perhaps could have even a negative impact, in the sense that when you have a highly insulated, highly compartmentalized, highly what you call segmented kind of institutional mechanisms within the market, there is an advantage in the sense that you don't get the best advantage of what happens in the other segments, but you don't lose from what happens in the other segment. Just like we say, globalization also has two positive impact. When you globalize your market, you have wide selection of products, you have quick movement of products, you have better quality of products, but at the same time you also have a negative impact in the sense that because the market is globalized, something that affected some country will affect you. So the negative, when you're taking advantage of the positives globally, we need to also have some preparedness in taking precautions against the negative impact that can happen. So same here in the financial market. There is adequate scope for movement of funds, there is adequate scope for spillover, there is adequate scope for taking advantage of return in another segment, for mitigation of risk, but at the same time, we need to have a safeguard, we need to have an element of precaution in seeing that something which negates one segment should not get its impact on another segment, because somebody who's saved with some purpose might lose on another count. Now that is exactly the reason why we saw RBI intervening in the huge bank exposition of funds to NBFCs. NBFCs started lending in a big way for gold loans. The risk that came there was a risk to the banks also, because the bank funds were deployed into NBFCs. So a person who deposits into a bank will find that a large part of bank funds have gone to NBFCs, and if there's a failure in the NBFC, perhaps that might have an impact on failure of banks. So to avoid that, RBI decided to intervene. So we need such kind of interventions. Perhaps if an IPO or maybe the secondary market instrument has been heavily subscribed by insurance companies, there is a possibility that if there is a failure in that particular instrument on which the investment went, there could be a failure in the fundamental insurance company which had an exposure over there. So these are some negative things which could happen, but on the positive side, there is always a huge opportunity to redeploy, to transfer, to take advantage of the segments, because there is a very strong integration that happens over there. There is high degree of specialization with regard to the way in which you can deal and use your funds in the market. So that's another important aspect where you can have high levels of specialization, because those who are in the derivative segment, the futures, the options, the exchange traded funds, that in that segment they are rich in terms of deployment and reuse, and weaknesses and corrections there could perhaps be professionally managed as far as their enterprise is concerned. Another important feature that we were trying to look at as far as the developed market is concerned is the uniform pricing that could prevail. Earlier I just mentioned, as far as the commodities, daily use commodities that we see, prices tend to vary within the city. In a particular city itself, the price varies, and the reasons for that is transportation cost, lack of awareness, convenience. I buy where the product is very easily available. I am not bothered about the price in a different place which is higher because I don't have time, or I don't have awareness about the varying price. So all these affects commodity price. But if you look at the price of a security or a share that is there in a market, it is uniform in almost all the markets. The variation between NSE and BSE, or the variation between one exchange and another exchange, is very narrow. And the reason for that is nobody trades physically. You do your trading online, you know the prices as visible on the screen. So it is all transparent and it is all converging at a point. It is not a physical, tangible kind of a thing, it's a financial asset. So there's a big difference between a financial asset which gets traded on in a financial market vis-a-vis a tangible physical assets which gets traded in a commodity market in a physical form. Now when you are dealing with a financial asset, the financial assets in the financial market are traded online. By and large, even your NSE and BSE have gone into the demat mode. So the values are all available on your screen. You see them physically, you see them online, and you know where the price differentials are. And the prices would obviously tend to be uniform, and that uniform price that prevails, the transparency that exists in the dealings, and the entire aspect of taking advantage of differentials is not that significant in terms of the place where you trade. Finally, another developed market feature is the straight through processing, what you call STP, that exists. Straight through processing was introduced maybe now around more than 15 years back in the Indian capital market, where you have your front office, your middle office and your back office getting integrated. That means you are technologically blended in terms of placing the order, getting the verification, and finally getting through with the transaction with a yes or no to it. Say for instance, if I am placing an order for purchase in a financial market, this gets verified using my bank account. If I have money, that is verified and a clearance is given. If I have no money, my order is rejected. Then it goes through the next step into verification of my demat balances. Then if that is cleared, it goes to the back office and the order is placed and the money is taken from my bank account. It is all integrated with technology. This is the straight through processing that you have. These are some of the features of our market, of an integrated market that we have. Now, what are the advantages? How do we take advantage of such a market that we have over here? The key advantage of the market that we have is the gap between the segments have been bridged, as we saw earlier. Integration has bridged the gap between the segments in the market, and that integration or that bridging of the gap has been a major advantage, as we have already seen in the earlier session on the integrating of the sub-market. Then you have a productive deployment of surplus funds. That is a key advantage, because when we saw that there is surplus funds with the banks, they can perhaps think of redeployment in another sub-market. When you see there is surplus funds in the debt market, it can move into the equity segment, or when there is surplus in the equity, it can move into the derivative segment. There is provision for deployment or redeployment of funds based on where there is surplus and where it remains to be in deficit. Again, we have a compact and integrated market which facilitates, which ensures control by an external agency, because that external control that is existing there is what creates the right kind of shift in our operations. Fundamentally, in Indian economy, at one point of time, we were talking about self-sufficiency. Now, subsequently, we said more important is self-reliance. The key difference is, when I am saying self-sufficiency, we are talking about having everything and anything that we want within our country. Self-reliance, on the other hand, says we need not have everything that we need, but we can have the purchasing power to buy what we actually need. So, if we are having our capital market, which has the strength to pull in funds from wherever there is surplus, deploy funds wherever there are opportunities, then that kind of a corporate link will stand as a key aspect as far as the robustness of the market is concerned. Now, we also need to have a very positive attitude maintained towards what we call the main use of our resources, the positive and the good use of resources, and there also we have to bring the right systems in place. This is an advantage. You have a positive attitude because everybody knows that this is regulated, this is transparent, this is something which is visible, something which is known to all. So then that makes your market more live to the conditions that prevail in the financial market. Now, let us look at what exactly are the functions of this financial market and how these financial markets function with these operations or with the role that they have to perform. Now, many of these functions, as we saw earlier, the functions of the financial system. Under the financial system, the financial market is a key component. So, this would obviously act as a positive component over there. First function is to ensure or facilitate transfer of funds from areas of surplus to the areas where they are deficit or they are needed. Basically, in the financial system, we saw to procure funds from the savers and to ensure that they are deployed by the investors. The second important function would be the linking of the participants, linking participants in the capital market through formal trading channels, formal trading facilities, formal trading norms. When we look at say forward trading for that matter, even before we talk about hedge funds or even before we started thinking about futures and options, in the agriculture sector in India, when we never even had a capital market or a stock exchange for that matter, there was forward trading. Now, forward trading in the sense that you decide to sell an agriculture product at a future date with a price which is fixed today, and thereby you hedge risk. Now, the difference between that forward trading and the hedging that you have today is the presence of a formal trading platform which is regulated. Now, in the historic agro-based trade, suppose I agree to buy 100 bags of rice or wheat at a price which is fixed today, and maybe 6 months later, I know that the price prevailing in the market today is a lower price. I agreed earlier to buy at a higher price. Now, what happens if I break the contract? In the conventional or the traditional agro mode, I had a forward contract signed, but it was not supported by highly specialized regulated trading platforms or channels. So, what happened if I break the contract? The only mechanism or the only only way in which the aggrieved party can turn against me is to go for a case, perhaps under the Contract Act or something. There was no commodity exchange or a formal exchange or a formal trading platform which ensures that the forward trade takes place. But today in the financial market, you have a formal trading system, you have tradings based on margins, you have conditions prevailing, you have cost which is defined, you have brokerage which have been defined, you have the terms and conditions under which the members can operate have been defined. So our trading platforms are quite formal and well developed over there. Then again it supports product innovation. That is how earlier when we were just saying that you have trading in the stock market in an outcry form. That was a time where you had a trading time and you had a trading place. If I had to buy securities or sell securities, I need to go to a stock market which is nearby. There was a trading time. I through a broker, I enter the hall. I cannot enter if I am not a broker. The broker will enter. There is a trading time. The outcry mode is followed, and there was no transparency on what happens within the hall. Now today, we have all kinds of innovative products which talks about the entire mode of operations in a very transparent form. So we have basic debt instruments, we have varying kinds of bonds, we have different kinds of funds, we have funds which are created out of funds, we can buy scripts, we can even buy indices, we can trade in commodities or we can trade in exchange traded funds which have underlying assets as commodities. So it gives ample scope for promoting product innovation. There is provision for liquidity. That means when you have a very developed financial market, it functions as a means to ensure liquidity. If I sell a share, I know up to what time I'll get back the money. If I'm trying to sell off or liquidate my mutual fund, I know by what time I'll get the NAV based price for my mutual fund. So it ensures adequate funds, liquid funds with the savers in the market. Then there is provision for profitable investment, because I know whenever I have, even with a small amount, I can invest in gold. Because I'm not investing physically in gold. With a small amount, I can invest in oil. With a small amount, I can invest in spices. I can invest in shares. So even with a small savings that you have, you can pool it. And we have many, profitable channels through which you can enter the market using systematic investment plans and all. So there are lots and lots of profitable investment avenues, potential for investment in the financial market, not just for ordinary individual investors, even for institutional investors who could be domestic or foreign portfolio investors. They all have ample options for the deployment of funds.